Hello, everyone, and welcome back to Nonprofit Auditor Points. And I'm Irina Ryshkova, your nonprofit auditor. And we continue our series on fixed assets discussion. In our last episode, we discussed fixed assets disposal, fixed assets inventory procedures, maintaining accurate fixed asset schedule. And before that, we spent a little bit of time discussing capitalization, proper recording fixed assets, and depreciation. So I will welcome you to look any prior NAPs if you need more information on these topics. But today we're going to focus on another area that creates a lot of confusion in accounting. It's construction in progress, often called CIP, and the concept of placed in service. This topic becomes especially important when the organization involved in large projects that typically involve renovating the buildings, construct facilities, install major equipment, implement new software systems, or complete large capital projects over the months or even years. And from the audit perspective, this is another area where nonprofits make a lot of mistakes. And the reason for that, because these projects do not happen often. So nonprofits either don't have a good understanding how to record these transactions, or they lacking policy procedures, or simply don't have internal knowledge and experience in order to handle these transactions correctly in accordance with GAAP. Sometimes nonprofits start depreciating these assets too early. Other times, projects are already operational, but balances remain sitting in a CIP in construction in progress for months or even years. And sometimes organization capitalize costs that should not have been part of the project, or sometimes they capitalize assets that they not capitalize necessary costs. So today we're going to talk about what construction in progress actually means, why CIP, while it's still CIP, is not depreciated, what place in service means, and what costs are accumulated in CIP, and some of the most common accounting issues related to CIP. So let's start with the big picture. A fixed assets usually goes through several stages in its life. The first, organization plans and approves the project. Then organization begin construction or renovation or installation or just starting the work. During that phase, costs may accumulate in CIP. Eventually, the project ready to be used in operations, and at that point, the project is placed in service and should be moved physically in the accounting records from CIP to appropriate fixed asset category, and then when we will start depreciating it. And finally, years later, asset may eventually be disposed, replaced, sold, retired, etc. So construction in progress is essentially the stage between starting the project and placing the assets in its operational use. Now let's define construction in progress more specifically. Construction in progress generally represents accumulation of the costs related to long-term asset and that are still under construction or under installation and has been renovated and developed, but it's not in use yet. For nonprofits, common examples include buildings renovations, leasehold improvements, major equipment installations, new facility, playground constructions, technology systems implementation, and internal use software projects developing. Importantly, CAP is part of the fixed asset. So construction in progress is recorded as a part of fixed assets, but it's usually not depreciated because it's not has been put in intended use yet. It is usually appears within property and equipment in the financial statement category, although it has to be presented separately as construction in progress or asset under construction. Now, here's one of the most important concepts in today's episode. Constructions in the progress are generally not depreciated, and we need to remember that. Why? Because depreciation is intended to allocate the cost of the asset over the period benefiting from its operational use. While an asset is still under construction and not ready to be used, there is no operational benefit yet. So there is nothing to allocate. So until the asset is ready for its intended use, depreciation does not begin. And this leads directly to placed in service concept. The asset is generally considered placed in service when it's substantially complete and ready for its intended operational use. That does not necessarily mean that every minor detail is done and every punchline item is completed or asset is being used in full capacity. The key issue is whether asset is ready for intended use. There still can be some parts under development, but if it's ready and can be used, we can start depreciation. For example, suppose a nonprofit complete a major office renovation. Maybe a few cosmetic touch-ups still remains, maybe even few offices still need to be remodeled. Maybe one storage room is unfinished, but if the organization has already moved stuff into renovated spaces and using it in operation, the project may already be considered placed in service if a minor remain is incomplete. And this timing matters because placed in service is generally the point where depreciation begins and CAP stops accumulating costs related to completed project. And we will need to move CAP to related fixed assets and start depreciating it. So let's talk about what costs usually go to CAP during the construction or implementation. Under GAAP, organizations should capitalize costs necessary to bring the assets to the condition and location required for its intended use. Therefore, CAP will include contractor payments, construction materials, architect, any permits, engineering fees, installation costs directly attributed to labor, fees, and expenses, and certain overhead costs directly related to projects. And for qualifying projects, some organization may also capitalize interest if the borrowing was made for the construction purposes. Now, I don't want to go too deeply into interest capitalization in this episode because the topic alone it's very technical, but there is a possibility that interest costs can be capitalized. But conceptually, interest capitalization generally applies while construction activities are in progress. Expenditures are being made and assets are being prepared for intended use. So importantly, we have to remember that interest capitalization generally stops when the asset is substantially complete and ready for its use. Let's go through a few practical examples because this topic becomes much easier to understand through real life examples. Suppose a nonprofit is renovating a building. And during the construction, contractor billings, engineering fees, permits, and other qualifying project costs may accumulate in CAP account. In that stage, depreciation does not begin because renovation still not operational. Then eventually, renovation is completed and organization begin using the space. And that moment, CAP balance is transferred. So we're crediting CAP and we're debiting appropriate fixed asset category, for example, building improvements, and we begin depreciation. So for example, over the period of 6 months, organization paid contractors, fees, permits, architect, various fees that amounted to $500,000. And then the project was done, and the organization will, all these fees should have been recorded in CAP, which is balance sheet account. Then once the project become operational, put in service, we debit building improvement and credit CAP, and we'll start depreciating. Now let's take a look at another example, equipment installation. Suppose the nonprofit purchases a large commercial kitchen system for a community program. The organization may incur shipping costs, installations, electrical setup, contractor work for the equipment, and so forth. All these costs not recorded as expense, but rather recorded as a CIP, which is a balance sheet fixed asset account, until the kitchen installation is done. And once equipment becomes operational and available to be used as a kitchen, the organization will put it in service, meaning will start using it, moves CAP to kitchen, debit kitchen and credit, which is fixed assets, and credit CAP, and will start depreciation. Software project can have a similar timings and recording. And suppose nonprofit implements a new accounting or donor management system. During the development and testing, certain qualifying implementation costs may accumulate as a part of software project, and they will be recorded as a CAP. Once the software system is major model is substantially completed and used, that's when we start amortization expense for the intangible assets. We don't call it depreciation, it's amortization. And CAP decreased, and we record fixed assets, which is IT asset. Now let's talk about more very common audit issues that relate to CAP and timing of placing in service asset. The common problem, depreciation, is start too early. For example, the organization sometimes begins depreciating project while they're still under active construction and not operational. We cannot do that. Another common issue is opposite. Depreciating is too late. Auditors often encounter problems when we see that the asset have been fully depreciated for part of the year, but the asset still sits in CAP, not moved and not depreciated. So from the audit perspective, this may understate expenses and overstate net assets. So the auditors very often look at evidence that indicate that the asset have been put in service. We're looking at occupancy permits, move-in dates, software go live dates. We're reading minutes of the board of directors, maybe agreements with the landlords, with the tenants, inspection reports, or evidence that assets is already being used in operations. Another issue auditors frequently encounter is old CAP balances that were never cleared properly. Sometimes projects are completed but never transferred out of CAP. Other times, projects are abandoned entirely but continue sitting in the books as CIP for years. And occasionally, organization capitalize costs into CIP. They should actually have been expensed immediately as repair, maintenance, or operational costs. So, construction in progress accounting require organization to carefully analyze project, understand when the entire project is done, and complete CIP, close it, and don't use it until the next project will start. So before we finish today's episode, let's summarize the key ideas. CIP represents costs accumulated for long-term assets that's still being constructed, installed, renovated, or developed for organization use. CIP is generally not depreciated and not put in service yet. Once the asset becomes substantially complete and ready for its intended use, the project is generally transferred out of CIP and placed in service, and depreciation begins. The date placed in service, that's the date when we start fixed assets accounting, meaning we start depreciating it. So now next episode, we're going to focus on another important area of fixed assets, land and building allocation. We will discuss why land treated differently from building, why land itself is generally not depreciated, and how organizations allocate purchase price between land and building, and other common issues related to land improvements and property acquisitions. Thank you so much. I hope you will find this information useful. Thank you for being here with me. Have a wonderful rest of the day and be safe.